Hello everyone. Very good evening everyone. How are you all? I hope everyone is doing great. Can you let me know, is everything fine? Video, audio, everything is fine so that we can start today live session. Great. Is everything is fine? Super. So how are you everyone? Great. Okay, now today of course we are going to start a new India accounting standard and today is day 5. One just a reminder to everyone that today is the last day the video will be available on YouTube. From day 6, whoever is coming in live with me, they will be only benefited with the practice batch. Okay, means once the live class will be over, then the video will be removed from the YouTube. So make sure that if you want this practice batch free, you need to attend live from 6 p.m. to 8:30 p.m. and don't ask me this question again and again. Okay, one more question. How many of you have completed the all the questions whatever we have done for all Indias, whatever we have covered? Have you completed all the questions? Have you done the self practice by your own? I'm getting doubts in my WhatsApp group, but many few are replying. Try to understand, in that WhatsApp group we have a student of 8 and more than 900 students. But when you are coming to attend live, means just try to understand what is the ratio of seriousness. Means very few are serious. So that is only the good point for you all. Whoever is coming live and watching this video, it means you are disciplined. If you remain disciplined for the coming attempt, trust me, I always say whoever is disciplined, that is only 20% of student and 20% is the result. So you need to be only disciplined and be in 20% for the next attempt. You will become CA. That is my word, you will become CA. Okay, now we can start. I'm only asking about the question which I have given. If you can complete entire question, that is super. But first complete whatever question I am giving for the self practice, because that are important question and that will be helpful to understand the concept. If you can complete entire question, that is super. Means that cannot miss. That is always favorable. Okay, now let us start a new India's 20. Very simple. Means today I just want to cover 3 Indias. First is 20, then India's 10, then India's 37. 3 Indias I have. This is my target for today. All are small Indias but important from examination point of view. Okay, last attempt from India's 20 we have got 8 marks question. There was a question of ICS study material only, but how you are writing? If you are not writing perfectly, they are not going to give marks. Small chapters means more perfect answer is required. Got this point? Yes sir. Now coming to the chapter, India's 20, accounting for government grant and disclosure for government assistance. Now there are two terms, government assistance and government grant. Just try to understand, government assistance is a wider term. It includes government grant. Means all government grant are government assistance, but all government assistance are not government grant. Means this chapter in India's 20 deals with the accounting of government grant, but only disclosures of other form of government assistance. Means India's 20 does not deal with the accounting of that government assistance, that does not mean the meaning of government grant. It means first we need to understand what is the meaning of government assistance. So government assistance means, these are government assistance means what? It is an action by the government, any action by the government. Government assistance is an any action by the government designed to provide economic benefit, which will provide economic benefit either to a specific entity or a group of entity. Means any action by the government. Now sir, who is government? Government can be state government, central government, any government agencies, any bodies which can be national body, local body or international bodies. Okay, so this can be government. The government does not mean only central government, only state government. It can be government agencies, it can be any body which can be national, international or local body. Are you able to understand? Yes, sir. So any action by the government designed to provide economic benefit either to a specific entity or to a group of entity, that is government assistance, correct? But all government assistance are not government grants. So what is the meaning of government grant? So government grant are government assistance in the form of transfer of resource. In the form of transfer of resource means something has been transferred which is in the form of resource. Can you see, when I say resource means asset. Asset can be cash, or it can be any other asset, means it can be monetary or it can be non-monetary. It can be monetary or it can be non-monetary also. It can be non-monetary also. So in the form of transfer resource to an entity, for past or future compliance, means it can be for the past compliance as well as future compliance with certain condition relating to operating activities. With certain condition that is related to operating activities, means it should not be related to any financing or investing activities. I hope you understood. Just try to understand one point. If suppose government is participating in any entity as a equity participant, that means it is related to financing activity, and that will not be covered under definition of government grant. That will not be covered under definition of government grant. Yes, sir. So government grant are the assistance from the government in the form of transfer resource to an entity for past or future compliance with certain condition relating to government entity. Means to be simplified, to make it simplified, whatever government assistance are there, if it is to public at large, means if it is given to public at large, it is not covered in this chapter. Outside the scope of this chapter, Ind AS 20 is not applicable. For example, government has provided telecommunication services, transportation services to public at large outside the scope of this chapter. If it is to a specific entity or group entity, of course Ind AS 20 will be applicable. But if it meet the definition of government grant, then Ind AS 20 is applicable for both accounting and disclosure. But if it does not meet the definition of government grant, Ind AS 20 is applicable only for the disclosure, not for the accounting, Got this point? Bolo. Have you understood this much? Okay. Meaning is very much simple now. Correct. Already I have said government refers to government agencies, similar bodies, whether local, national or international. Now, government grant will not include, as clarification has been given, that government grant will not include to government assistance to which monetary value cannot be placed, Simple speaking, if I will say example, any free technical advice given by the government. Suppose to an entity, government has given free technical or free marketing advice, it cannot be expressed in the monetary term, therefore outside the scope of this chapter. However, it is a government assistance which will not be the definition of government grant. Means can I say for this only disclosure required? Because this will be a government assistance which will not be the definition of government grant. Normal trading transaction with the government, if you are doing any normal trading transaction with the government, in that case if you receive some discount, so that discount is not a government grant. Okay sir? Yes sir. Now can you repeat with me? Government participation in ownership of the entity, Ind AS 20 is not applicable. Government grant related to biological asset other than beer plant, Ind AS 41 is applicable. Last class we have done, so Ind AS 20 is not applicable. Government grant related to beer plant, you only say government grant related to beer plant, whether Ind AS 20 will be applicable, yes or no? Very fast. Yes, it will be applicable. Free technical advice from the government. Right now you will say me this point. Free technical advice from the government, whether Ind AS 20 is applicable or not applicable. Everyone, fast. Point number D, I am asking free technical advice received from the government, whether Ind AS 20 applicable, not applicable. Fast. Excellent. Applicable but only for disclosure. Very good. Excellent means you are just, I was just checking whether you are listening or not. Means you are listening perfectly. Super. Government assistance to public at large not applicable. Any tax holiday, any investment tax credit, any depreciation means additional depreciation of whatever related tax that is covered under Ind AS 12. So if suppose any tax holiday means tax exemption is given, that will meet a definition of government grant, but that is outside the scope of Ind AS 20, because for that we have a specific standard Ind AS 12 that will not be covered in this chapter. Okay. Now coming to next point, which is very important, recognition of government grant. Can I ask one question right now? Can we recognize government grant on accrual basis? On accrual basis means just try to understand. Can we recognize government grant even though it is not received? Even though it is not received, yes or no? Can we recognize government grant on accrual basis, or we should recognize government grant only on receipt basis? What do you think? Everyone fast. Correct. My question to you all, can we recognize government grant on receipt basis only, or we can recognize government grant even though it is not received? Everyone is wrong. Everyone is wrong. Correct. Just try to understand, you are here for this, and from this point one question have been, I will say, two times the question have been asked in exam, and there is a difference of concept. Even though you have not received, government grant can be recognized on accrual basis. Just try to understand, we do accounting on accrual basis or receipt basis? You only say, we do accounting on accrual basis or receipt basis? We do accounting on accrual or receipt? Everyone reply. Of course, can I say we always follow accrual concept? We always follow accrual concept. We don't follow cash basis accounting. How can you say that government grant will be recognized only on receipt basis? It means basic concept doubt. Basic concept doubt. So what Ind AS 20 says, that we can recognize government grant on accrual basis if two conditions are satisfied. How many conditions satisfied? Two conditions satisfied. Understood? What are two conditions? The government grant should be recognized only when there is a reasonable assurance. That reasonable assurance means chances are more than 50%. Reasonable assurance means chances are more than 50%. So government grants should be recognized only when there is a reasonable assurance that entity will be able to comply with the condition attached with that, and the grant will be received. And grant will be received means there is a certainty of collection. If these two conditions satisfied, we can recognize government grant on accrual basis also. We can recognize government grant on accrual basis. Understood? One second. Government grant can be recognized on accrual basis when there is a reasonable assurance that the condition attaching with the grant will be complied and grant will be received. It means, can I say in this way? Can I say in this way? If these two conditions satisfied, if these two conditions satisfied, then what will be your journal entry? Grant receivable account debit to government grant. Correct. However, if this two condition is not satisfied, so can I say we need to wait for the actual collection of the grant, and once it is received, we'll recognize the grant, we recognize the government grant. So if it is not received right now, so we need to wait for the actual receipt if the condition is not satisfied. And once received, so we can say bank account debit to government grant, bank account debit to government grant. Means, can I say we can recognize either on receipt basis or receivable basis, whichever is earlier, whichever is earlier, whichever is earlier. Understood this point? Have you understood this particular point? Correct. Correct. It means, can I say Ind AS 20 has given one simple clarification that even though you have received the grant, you can't recognize the government grant if the first condition is not satisfied. You need to also check the first condition whether you are able to comply with the condition or not. If you are not able to comply with the condition, even though you have received, government grant cannot be recognized. Then in that case, whatever amount you have received, that will be considered as a liability. Whatever amount you have received, that will be considered as a liability, means refund liability. That will be a refund liability. Understood this point? Correct. So only receipt of government grant is not a conclusive evidence that a condition attaching to grant have been or will be fulfilled. Therefore, I have given two journal entry. If the grant is receivable, and both the above conditions are satisfied, journal entry is grant receivable to government grant. If the grant is received and the condition 1 is also satisfied, then we'll pass bank account debit to government grant. What is the objective of this chapter? What is the objective of this chapter? In these two journal entry, what will be the accounting treatment of government grant? Correct. The objective of this chapter is that what is the accounting treatment of government grant? This is the objective. Correct. Have you understood this point? Are you able to follow me? Are you able to follow me? Say yes or no. Just try to understand is if receive and accounted and if the condition is not satisfied later on it become refundable, then we'll do the accounting treatment repayment. That is the last point of this chapter. That is the last point of this chapter. Abhi, right now we are doing about initial recognition. So initial recognition, if these two conditions are satisfied, recognize it. Got this point? Got this point? Yes, sir. Now try to understand. Now what Ind AS 20 say that there are two approach for the accounting treatment of government grant. There are two approach. One is known as capital approach. Capital approach. Second is known as income approach. Income approach. Capital approach means the government grant whatever received will be transferred to capital reserve. Capital reserve. And income approach means whatever government grant received that will be transferred to PL account. Whatever government grant will be received will be transferred to PL account. Got this point? My question to you all: when the government grant will be transferred to capital reserve? In what situation government grant will be transferred to capital reserve? Can you answer right now? My question to everyone right now: in what circumstances government grant will be transferred to capital reserve? So what Ind AS 20 says that there are two approach of accounting treatment for government grant. One is capital approach, one is income approach. In case of capital approach, government grant whatever received will be transferred to capital reserve. In case of income approach, whatever government grant is received or receivable will be transferred to PL account. So my question to all of you: in what circumstances government grant will be transferred to capital reserve? Everyone. If related to capital asset, promoter contribution, asset given free, subsidy for purchase of capital asset, subsidy for purchase of capital asset. I'm just waiting for everyone answer. When grant related to capital approach, when grant related to capital approach, that's why I'm asking. If received to a PP, we can transfer to capital reserve for capital asset. Everyone is wrong. Just try to understand. Government grant cannot be transferred to capital reserve as per Ind AS 20. Whatever answer you are giving, it might be as per AS 12 CA inter. Means right now you are in CA inter, not in CA final. This is the conceptual mistake, and here only student to mistake. Ind AS 20 last attempt 8 marks question came. Trust me, most of you may have done wrong. If you don't revise, if you don't practice, you think the chapter is easy. Maja aa raha hai. 8 marks gone. Try to understand. Everyone is wrong. Income approach is capital approach is not permissible. Ind AS 20 has given, but they say capital approach is not permissible. Capital approach is not permissible. Not permissible. Not permissible. Not permissible. Only income approach is permissible. Only income approach is permissible. Understood? Now you should never forget it. Means government grant as per Ind AS 20 will never be transferred to capital reserve. Well, God promise. Everyone say promise, promise, God promise, say and say government grant will never be transferred to capital reserve, will never be transferred to capital reserve, only income approach. Correct? Now Ind AS 20 says that either it will be transferred to PL immediately, either it will be transferred to PL immediately or it will be transferred to PL on deferred basis. Deferred basis means it will be treated as deferred income and will be transferred to PL over more than 1 year on some systematic basis. Correct? So what Ind AS 20 says that if there is some basis of allocation do not exist, then it will be transferred to PL immediately. But if basis of allocation exists, then it will be transferred to PL over more than 1 year on some systematic basis. Got this point? Have you understood this point? Bolo. So it means as per Ind AS 20, Government grant will never be transferred to capital reserve. It will be transferred only to SOPL either on immediate basis or on deferred basis. Now, whether it will be transferred to PL on immediate basis or deferred basis, that depends upon the nature of grant. That depends upon the nature of grant. Okay, sir. Now let us come to the chapter. So what they are saying, accounting approach, already I have said capital approach is not permittable. As per Ind AS 20, only income approach grant will be created to PL over one or more year. If basis of allocation do not exist, then recognize grant to PL immediately when the grant is received or receivable. However, basis of allocation exists, then recognize in PL on systematic basis over the period in which entities recognize related expense which the grant are intended to compensate. Means in simple word, as per matching concept. As per matching concept. Matching concept means government grant will be transferred to PL to match the related expense. To match the related expense which the grant are intended to compensate. So that will depend upon the nature of grant. So let us now come to the accounting treatment. Let us understand whether it will be transferred to PL on immediate basis or whether it will be transferred to PL on deferred basis. So first, grant relative depreciable asset. Can you give me some example of depreciable asset? Capital approach is applicable for CA, Inter, therefore in real life financial statement entity, capital approach is applicable or not. Just try to understand any entity who is following accounting standard, for them AS 12 is applicable. Any entity who is following Ind AS, for them Ind AS 20 is applicable. So what is your question? Real life means what? This is totally bakwas question. Now you just find out you are preparing your books of account based on Ind AS or based on AS. Then follow the relevant accounting policies. Then follow the relevant accounting policy. Okay, sir? Yes, sir. Any more doubt? So you have given, everyone is giving PP. Just try to understand. It will include property, plant and equipment. My question to you are whether it will include intangible asset. Yes, it will include intangible asset. Whether it will include investment property, but it will include investment property. But investment property, no one will give grant. For investment property, no one will give grant. Okay. So of course you can say investment property to the extent of building is a depreciable asset. To the extent of building, it is a depreciable asset. For PP, land is not a depreciable asset. For intangible asset, any intangible asset having indefinite life that are not depreciable asset. So depreciable include amortization also. Amortization. My question to you all, whether it will include bearer plant, whether it will include bearer plant, whether it will include bearer plant, whether it will include bearer plant. Yes, it will include bearer plant also. Bearer plant. Whether it will include other biological asset, whether it will include other biological asset, everyone. Yes, it will include other biological asset if they are measured under cost model. If they are measured under cost model. Last class, if you remember, we have done biological asset other than bearer plant. If it is measured under cost model, then government grant related to that for that asset will be covered under Ind AS 20. So these all are covered. When I say depreciable asset, PP, intangible asset, investment property, bearer plant, and biological asset other than bearer plant, which are measured under cost model. Which are measured under cost model. Understood? Have you understood this fine? Bolo. Yes, sir. Now, in this very simple accounting treatment, they have given two approach of accounting. First, they have said the government grant, whatever you have received or receivable will be deducted from the cost price of asset. So, grant is deducted from the cost price of asset. Means suppose the cost price 100 and you receive the grant of 80. So 80 deduct. So now the cost price of the property, plant and equipment or any other depreciable asset will be 20. And now you will charge depreciation on this 20 rupees. On this 20 rupees. Second, grant is treated as deferred income. In this case, whatever government grant is received or receivable will not be deducted from the cost price of asset, and that will become treated as deferred income. It will be treated as deferred income, and that deferred income will be amortized to PL on systematic basis over the useful life of asset in the ratio of depreciation. In the ratio of depreciation. So in this case, whatever grant you have received, that is treated as deferred income, and then deferred income will be amortized to PL over the useful life of asset in the ratio of depreciation. In the ratio of depreciation. Now be careful. If it is SLM, then to can you say the amortization will be equal because depreciation is equal. So if the useful life is 5 years, then amortize over the 5 year on equal basis. But if it is RBM, be careful. Then you need to first calculate the depreciation of all the useful life. Then you need to find out the ratio of depreciation. On the basis of that ratio of depreciation, amortize government grant. Till now, no question have been asked in exam for RBM method. Trust me, once the RBM method is asked, most of you will do wrong calculation. So be careful about that. Be careful about that. So deferred income is recognized in PL over the useful life of asset in the ratio of depreciation. Means in this case, what journal entry will do? First, we'll purchase property, plant, equipment. What journal entry? Property, plant, and equipment. Account debit to bank. Now, once the government grant received or receivable, if receivable, then receivable. If received, then bank account. Okay. Most of the question is with receipt only, therefore I am writing bank account. Bank account debit to deferred income. We'll say deferred grant. And now this deferred grant will be transferred to PL at the end of each year over the useful life in the ratio of depreciation. You can calculate and you will pass journal entry deferred grant to grant income, and that grant income will be transferred to PL. Understood? In this case, simple journal entry is what? For example, PP account debit to bank. First journal entry is PP account debit to bank. Second journal entry, whatever amount you have received bank to PP you can do, to property, plant and equipment you can do directly. Means you can credit the relevant asset. Correct. Now in this case, one situation may arise. What is the situation? Suppose the grant amount is 100 and the cost price of the asset is 100, correct now, or 80. Means in this case, just try to understand, once you deduct that the cost price of asset becomes 0, cost price of asset becomes 0. So what Ind AS 20 says that this is not correct from disclosure point of view. Therefore in this case, the relevant PP will be disclosed at nominal value. So whenever the grant is equal to or more than the cost price of asset, asset will disclose at nominal value only for disclosure purpose. That nominal value will never be depreciated. Nominal value means small amount can be 10 rupees, 100 rupees or whatever you like as per the management policy. Chalega. Have you understood this point? Point number A is correct. RBM method once again explain. RBM method once. RBM means what? Reducing balance method, means WDB method, means diminishing balance method. You know RBM now? Means suppose the 1 lakh is what? The cost price of asset, correct? And the rate of depreciation is 10%. So year 1, 2, 3, 4, 5, 6. So first year depreciation will be 10,000. Can you give me the depreciation? Bolo. Then second year it will be 9,000. Arey, what I am doing? ऐसा लग रहा है I am teaching बचपन. I go to बचपन. Then you will calculate depreciation of every year. Now whatever total depreciation you calculate, the total will be 1 lakh only. Correct? Now I am just taking an example. Now suppose the government grant, the deferred income is 50,000. So this 50,000 will be allocated in this ratio. 50,000 will be allocated in this ratio. Now understood? Now understood? Yes sir, understood. Can we move? Can we move? Yes sir. Coming to grant related to non-depreciable asset. Non-depreciable, only one example we have, that is land. Land. Normally we receive grant for land, non-depreciable asset. So what Ind AS 20 says that just you need to find out whether government grant require fulfillment of certain obligation, means whether it is conditional grant or unconditional grant. Whether it is conditional grant or unconditional grant. If it is unconditional grant, means no obligation exists, then entire grant whatever received or receivable will be transferred to PL on immediate basis, means transfer to PL immediately. No basis of allocation exists, credit to PL immediately. So if there is no fulfillment of obligation, means there is no condition, entire grant will be transferred to PL immediately. But if obligation exists, for example, you receive grant for agriculture land, with that you have an obligation to develop irrigation facility within 5 years. It means can I say you need to incur some expenses to develop irrigation facility. It means you need to estimate that cost, and in that cost, means in the ratio of that cost, you need to transfer government grant over the 5 year, over the 5 year. Understood? The basis of allocation exists because you have some condition to be fulfilled, treated as deferred income and recognized in PL over the period that bear the cost of meeting the obligation. Have you understood? So in this case, it is treated as deferred income and recognized in PL over the period in the ratio of the estimated cost of meeting that obligation. Correct? So for example, develop the irrigation facility in 5 years and your cost is suppose 1 lakh, 2 lakh. Suppose your cost is what? 1 lakh, 2 lakh, 3 lakh, 2 lakh, 4 lakh. So in this ratio, the government grant will be transferred to PL every year. Understood? Nothing to worry. This estimated cost will be given in the question. The estimated cost will be given in the question. However, if question is silent about the land or non-depreciable asset, always assume this. If question is silent, always assume this. Understood? Chalega. Then coming to non-monetary grant. Non-monetary grant means grant receiving kind. Grant receiving kind means you have not received cash, you have received directly the asset. For example, you receive property, plant, equipment, you receive intangible asset, you receive land. In that case, you have two options. Either recognize at fair value or recognize at nominal value or concessional value. Understood? Yes, sir. So either recognize at fair value or recognize at nominal value or concessional value. Let me take one example. Suppose you receive land whose fair value is equal to 100 lakh. Now either it has been received free of cost or it is received at concessional price. Suppose it has been received at 10 lakh. Now in this case there are two options. Either recognize land at fair value. So your government grant will be also 100 lakh, or you can recognize land at nominal value. So you say land account debit rupees 10. Then you can transfer this to any reserve of whatever your choice. This journal entry has not been given by India's 20. This I am just doing to explain the journal entry, but this is only for book adjustment. This will not affect the financial statement. 10 rupees, 100 rupees will not affect your life. Okay, sir? Yes, sir. Correct. In this case, what journal entry? Land account debit 100 lakh to bank, how much it has been paid? 10 lakh, and government grant will be 90 lakh, or it will be recognized at concessional value. Concessional value is what? 10 lakh. How much you have paid? 10 lakh. This is 10 lakh. This two. Correct? Understood? Have you understood? You can see whenever we are recognizing at nominal value or concessional value, actually we are not recognizing any government grant. Means there is no subsequent accounting for government grant. But whenever we are recognizing at fair value, we have government grant, we have related government grant. So government grant will be treated as per the nature of asset. If it's depreciable asset, then recognize means amortized to PL on systematic basis over the useful life of asset in the ratio of depreciation. If it is non-depreciable asset, just see whether it is conditional or unconditional. If it is unconditional, transfer to PL immediately. If it is conditional, so you need to find out the estimated cost of meeting that obligation. Then that lets you transfer the deferred income to profit and loss account over the period. Have you understood this point? Have you understood this point? Bolo. Correct. Same thing is given. In this case, government grant is treated as deferred income and is recognized in PL on systematic basis. On systematic basis. Correct. Then coming to grant related to income. Grant related to income is grant related to revenue expenses. Revenue expenses means employee salary or any other expenses which are related to operations. Understood? For example, purchase of raw material. In that case, simply speaking, what India's 20 says that it will be treated as deferred income and recognized in PL on systematic basis over the period necessary to match with the related expenses which they are intended to compensate. For this, I like to take one question. However, for this, what India's 20 says that whatever government grant has been transferred to PL on systematic basis over the period to match with the related expenses which they are intended to compensate. For presentation purpose in SOPL, there are two methods. Either the grant can be deducted from related expense in SOPL, or that grant can be transferred to PL as other income. The two presentation has been given. he either presented in PL as separate income or any other income, or presented by way of deduction from related expense. But this presentation is only for this grant, grant related to revenue expenses, means grant related to depreciation, sorry, grant related to depreciable asset or non-depreciable asset, that will be always shown as a separate income. That will be always shown as a separate income, other income that cannot be deducted from related expenses. Have you understood this point? For this, we have one question which is the favorite question of the institute now, and there is a lot of controversy in that because institute has revised the answer. I will like to take that question right now. This question 18, write down super expected, because institute has changed the solution for this, which was initially wrong given. When it was wrong given, we used to teach wrong, and I used to say because solution is, from my point it is wrong, but I can't go against the institute solution. But now they have corrected, and whatever solution is given, super solution they have given. Entity A is awarded a government grant of 60,000 receivable over 3 years, 40,000 in year 1, 10,000 in year 2, and 10,000 in year 3, contingent on creating 10 new jobs and maintaining them for 3 years. The employee are recruited at a total cost of 30,000. So what is the recruitment cost? 30,000. And the wage bill for the first year is 1 lakh. Means first year, what is the total expenses? 1 lakh plus 30,000, that is 1 lakh 30,000. Rising by 10,000 in each of the subsequent year. Means second year the cost is 1 lakh 10,000, third year the cost is 1 lakh 20,000. Calculate a grant income and deferred income to be accounted for in the books for the year 1, 2, 3. Under two situations, they have given two situations. There is a reasonable assurance that entity will comply with the condition attaching to them and grant will be received. So can I say if these two conditions are satisfied, even though grant is not received, we will recognize it. Means in this case, can I say we will recognize entire 60,000 in year 1, entire 60,000 in year 1, because both the conditions are satisfied. So in this case, what will be your journal entry? Grant receivable to deferred income, 60,000 grant receivable to deferred income 60,000. It means now 60,000 will be allocated to each year in the ratio of related expenses. So you need to find out expense 1 lakh 30, 1 lakh 10, 1 lakh 20, and this 60,000 will be allocated in this ratio. Of course, you have calculator, you can calculate it. Got this point? Now we need to find out deferred income. The deferred income will be how much? The first year deferred income will be 60,000 minus 21667. Because out of 60,000, 21667 have been transferred to PL. Second year it will be 38,000, means whatever the opening balance, 38,333 minus 18,333. Then the third year it will be 20,000 minus 20,000, then nil. So this will be the amount of deferred income. I think in this, no doubt. I think first situation is very easy once you have understood. Any doubt about first situation? Reply. Any doubt about first situation? Reply. No, sir. Okay. Now coming to second situation, which is very good. There is no reasonable assurance, then grant will be received. So right now there is no reasonable assurance. Means can I say we recognize only when the grant is received. So first year how much received? 40,000. It means we can recognize only 40,000. Second year, let us assume second year 10,000 received. So we recognize 10,000 second year. And let us assume third year 10,000 received. So we recognize 10,000 in third year. Understood this point? It means the first journal entry will be grant receivable to deferred income only 40,000. Only 40,000, but how to allocate in this case? So can you say the labor cost will remain same, 1 lakh 30, 1 lakh 10, 1 lakh 20. Now first year we will amortize this 40,000 in this ratio. So first year you can see this 40,000 has been allocated in this ratio and you have allocated. Now second year how much? Again you receive 10,000. The second year 10,000 will be allocated. Can you say in this ratio 1 lakh 10,000, 1 lakh 20,000? So you can say second year this 10,000 has been allocated in the ratio of 1 lakh 10,000 and 1 lakh 20,000. That is the ratio of expense. And third year again you receive 10,000. That will be entirely allocated third year. It means the total grant income of first year. Total grant income of first year will be will be 14,445. Second year, it will be this amount. Third year, this amount. Now you can find out deferred income. The deferred income of first year will be 40,000 minus 14,445. So it become 25,555. Understood? Second year, be careful. Second year, can you see it was 25,555. Second year, it was 25. Already you have the opening balance of 25,555. Again, you receive how much? 10,000. You receive 10,000. Bole yes or no? From this, how much you have transferred to PL? That is 12,000 to 222 minus 4783. This will be your deferred income. Just calculate 25,555 plus 10,000. You again receive minus 12,000 222 minus 4783, and your deferred income is 18,550. Third year, it will be 18,550. Again, you receive 10,000, and how much you will transfer? Or you will transfer 13,333 plus 5217 plus 10,000. It means it is equal to 28,550. It will become zero, and it will become zero. Understood? This is super good question and 100% expected in exam. After the rectification solution, it was not asked in exam. It was not asked in exam. This question I am expecting in your exam. Chalega? Done. Done. Okay. Let me ask you one question. There is one question where there is some conceptual doubt. Let me think. Means let me understand whether you are giving me correct answer or not. Solution is very easy. Don't see the solution right now. Okay. A company received a cash grant of 30,000 on 31st March 2001. The grant is toward the cost of training young apprentice. The training program is expected to last for 18 months starting from the 1st April 2001. Actual cost of training incurred in the first year 50,000 and second year 25,000. State how the grant will be accounted. Let me explain. So there is what? There are 2 year, 2 year. This is March, 31st March 2001. So 31st March 2001, they have received 30,000 grant, and training expense will be for 18 months. Means this is 12 months, this is 6 months, and training expenses they have given 50,000 and 25,000. 25,000. Correct. So first journal entry will be done on 31st March, that bank account debit to deferred grant. Deferred grant. Correct. This is the first journal entry. Now my question to all of you, this 30,000 will be allocated in 2 year, first year and second year. I mean this year and this year. In which ratio? You have two ratio. One is time ratio, 12 month is to 6 month, which is 2 is to 1. And in the expense ratio, which is also 2 is to 1 in this question. My question to all of you, this will be allocated in the month ratio or expense ratio. However, in this question both are same, but in your exam question both can be different. My question to all of you, this 30,000 will be allocated in time ratio or expense ratio. Everyone answer right now. Now 2 is to 1 I understood. It will be in 2 is to 1, but it will be in the ratio of expense or in the ratio of time. Acha, everyone is saying correct expense ratio. I would like to ask you one question. Have you given expense ratio by looking into the concept, whatever I have taught right now, or seeing the solution? Means, have you seen the solution, or you are applying the concept? Concept means whatever I have said that you are applying, or you have just gone through the solution. Can you help me out for this? Means you have said expense ratio 100% correct, 100% correct. Super, I will say super. But have you applied a concept or have you applied a solution given by ICI? Or you told by me in the class now, in this class? Concept. So what is important? Concept is important, or I say a solution is important? Concept is important, but if you see the solution, Mahanalayak solution, I don't understand. And if you go to this solution now, you will die. Therefore, I always say don't refer the solution given by ICA during exam time. Always refer the class note given by your faculty. If you have done classes from me, just go through the class note, because the solution are totally bakwas. I don't know who is preparing this type of solution. They are not chartered accountant. Got this point? Yes, sir. So in this case, they have written this, they have done in month ratio. Okay, super galat. However, the answer is correct. Why? Because time ratio and expense ratio both are same. Okay, sir. Correct. In this case, they have also asked one more thing. Disclose the deferred income in the balance sheet. So can you say on 31st March, try to understand. On 31st March, this is 1 year, this will be 1 year, year end. So whatever you have received at the year end of this year will be deferred income is liability. So out of that, non-current portion will go to non-current liability and current portion will go to current liability. So out of this, can I say 20,000 is going to be recognized in 20,000 is going to be recognized in the first year, and 10,000 will be recognized after 12 months from the end of reporting period. So out of 30,000, 20,000 will be current liability and 10,000 will be non-current liability. Understood? Yes, sir. Same thing, same disclosure has been given. You can see the solution. In the first year, current liability is 20,000 and 10,000 is non-current liability. In second year, 10,000 become current and non-current will become zero. In the third year, both will become zero. Understood? Chalega? Yes, sir. Good. This also you have understood. Then forgivable loan. Forgivable loan means the government has waived the loan. In that case, what India 20 says that whatever the amount of loan has been waived, that will be transferred to PL immediately. That will be transferred to PL immediately if that two condition has been satisfied. Whatever the two condition about recognition criteria, if that is satisfied, that will be transferred to PL immediately. Therefore, loan account to grant income. Whatever is the amount of loan which has been waived, that will become grant income, and the grant income will be transferred to PL immediately. Concessional loans, super important from examination point of view. So whenever there is a concessional loan, so India's 20 says that first we need to find out a fair value loan as per India's 109. So we need to find out fair value loan. So loan is recognized and measured as per India's 109. Now as per India's 109, we need to find out the fair value of loan, and fair value of loan will be the present value of contractual cash inflow discounted at market rate of interest. Market rate of interest means, suppose the market rate of interest is 10%, but the loan has been given at 2%, this become concessional loan. So first you need to find out the fair value loan as per the requirement of India's 109. Of course you can calculate it. Now whatever the loan amount received less fair value loan, whatever the difference, this difference will be considered as government grant, and this will be accounted as per India's 20, and loan will be accounted as per India's 109. Loan will be accounted as per India's 109. So what will be journal entry? Bank account debit to loan payable to deferred income, deferred grant. Okay, so bank account debit to loan payable to deferred income, and this deferred income will be amortized to PL on systematic basis as per the nature of grant. Means if this loan has been received for the depreciable asset, so over the useful life of asset in the ratio of depreciation, so as per the nature of grant. Understood? Have you understood? Same thing is given. Deferred grant to be recognized PL on systematic basis over the period in which entity recognized as expense the related cost which the grant are intended to compensate. Have you understood this point? Have you understood this point? We can take one question on this, but I will take at the end. For this point number F, I will take question at the end. But have you understood or not? Point number F, concessional loan, have you understood or not? Concessional loan once more. So let me take one question if you are not able to understand with this. So come to one question, because ho sakta if you are doing for the first time, if you don't know Ind AS 109, then you are asking this question. If you have done Ind AS 109, I think the doubt will not come. Am I right or not? Those who are seeing concessional loan once more, from my point of view, if you are doing for the first time, am I right or not? Say yes or no. So let me take one question based on this. Come to question number one. Good question, question 5. Let us come to question number 5. Question number, you can see A Limited received from the government a loan of 50 lakh at 5% payable after 5 years in a bulleted payment. Bulleted payment means this 50 lakh will be repaid at the end of 50 year. 5% become the contractual rate of interest. The prevailing market rate of interest is 12%, so it is a concessional loan received from the government. Therefore, it is a question of Ind AS 20. Interest payable regularly at the end of each year. Calculate the amount of government grant and pass next journal entry. Also examine how the government grant will be recognized. It means, can I say, first we need to find out contractual cash inflow. So contractual cash inflow will be calculated by applying 5%, 5% of 50 lakh means every year how much interest. You can see interest will be what? Every year 2 lakh 50,000, 2 lakh 50,000, 2 lakh 50,000, 2 lakh 50,000, 2 lakh 50,000 for 5 years. And at the end 50 lakh will be repaid. So at the end of 50th year 50 lakh will be repaid. Now we need to find out the present value of this contractual cash inflow discounted by using market rate of interest. What is the market rate of interest? That is 12%. So you can easily calculate discounting factor 12 now. 12%. You can easily calculate the discounting factor by applying 12%. This becomes the amount of loan. Means loan is measured at fair value as per Ind AS 109. What is the amount you receive? You receive 50 lakh. Out of that, what is your loan amount? Loan amount is this. The difference will become your grant amount. This become your grant amount. Understood? So this is the grant. This is the loan, and this is the total amount you received. Understood now? Have understood? Now this will be accounted, means subsequently accounted as per Ind AS 109. Ind AS 109 says that this will be accounted by applying amortized cost by applying EIR. So amortized cost of course will do correct now, and this will be transferred to PL over the year on systematic basis as per the nature of grant. Suppose this particular loan has been received for purchase of property, plant, equipment, so this will be amortized in PL over the useful life of asset in the ratio of depreciation. Got this fine? Have understood? You can see they have also calculated the amortized cost of loan. So this actually this entire table is as per Ind AS 109. It has nothing to do with Ind AS 20. So you can see if you know about amortized cost table. So this is the opening loan. On that interest income will be calculated 12%. And what is your payment? Payment is 2 lakh 50, 2 lakh 50, 2 lakh 50, 2 lakh 50, and at the end it is 52 lakh 50,000. So you can calculate interest income by applying EIR. EIR is 12%. However, this amortized cost table will be discussed in detail in financial instrument chapter. Now understood? Now understood. This is the major part. Have you understood how to calculate fair value loan? Once you are able to calculate fair value loan, then only we can calculate the grant amount. Chalega? Yes, sir. Now, next point. There are two exceptions. What is the exception? What Ind AS 20 means, whatever this we have discussed till now, can I say grant, all the grant, we have transferred it to what? Means we have treated a grant as a deferred income. So what Ind AS 20 says that there are two situations in which grant will be transferred to PL immediately in the year when it is received or receivable. Correct? Means always the grant will be transferred to PL in the year in which the grant is received or receivable. There are only two circumstances. First, grant received or receivable to compensate any past expenses or losses. Means if you have received some grant for the past expenses, whenever you have received or receivable in the year, entire grant will be transferred to PL account. A grant is received or receivable as reward for the purpose of immediate financial support with no related cost. With no related cost means without any condition, means it become unconditional grant. In simple word, if any unconditional grant is received, the grant is transferred to PL immediately when the grant is received or receivable. In these two situations, grant will be always transferred to PL when received or receivable. Understood? Chalega? Yes, sir. Then coming to repayment of government grant. This is important. This is important. Repayment of government grant. So repayment means the reverse journal entry. It is the repayment will happen only when the condition is not satisfied. So initially you have recognized the grant and you have transferred some amount of grant to PL account. After some year you find that that condition is not satisfied and it is due for refund. In that case, what journal entry will be done? In simple word, what Ind AS 20 says that the account which was initially credited now will be debited. So if it was initially credited to PL, you will say PL account debit to GG payable, government grant payable. If it is initially credited to Asset means property, plant and equipment account. So now PP account will be debited in simple, but let me explain. The accounting treatment depends upon if the government grant was initially transferred to PL. Now the journal entry will be PL account debit to GG payable, then GG payable account debit to cash or bank. If initially it was deducted from the cost price of asset, so now the journal entry will be asset account debit to GG payable and GG payable account debit to cash or bank. Can you see when you do this journal entry, then of course the carrying amount of property, plant, equipment will revise. So revised carrying amount will be depreciated over the remaining useful life on prospective basis. On prospective basis, of course, yes, sir. Now, important is what if GG is treated as deferred income. If GG is treated as deferred income, in that case, let me take one example. Suppose the grant received was 10 lakh. Out of that, you have used, and there was some amount which remained unused. Unused is 2 lakh, and you have used 8 lakh. So a grant was related for the purchase of PP, and you have acquired PP amounting to rupees 8 lakh. My question to all of you in this case, deferred income will be 10 lakh or 8 lakh? Deferred income will be 10 lakh or 8 lakh? Everyone. You receive grant of 10 lakh, but you unused amount is 2 lakh, used amount is 8 lakh. Are you getting what I am saying? Are you able to understand? So in this case, deferred income will be 8 lakh or 10 lakh? Till now, this type of question has not been asked in exam. But at CA final level, we can expect this type of questions. Okay, so deferred income will be 8 lakh or 10 lakh? Just try to understand. If you are saying 10 lakh, then to wrong. How much you have used, that only can be deferred. It means this is liability. This will be considered as grant liability only. It is refundable. If you have not used, means the condition is not satisfied from a day one. And this will be deferred income. This will be deferred income. Out of that, some amount has been amortized to PL. Suppose amortized to PL is 2 lakh and some amount remain unamortized. Unamortized means it will remain in the balance sheet as deferred income in the liability side of the balance sheet. So this is 6 lakh. And now refund happened. Now refund happened. Correct. Now suppose the refund amount is 10 lakh. So what India says that first you should debit grant liability account. What is the grant liability? 2 lakh. Then you should debit deferred income account, that is 6 lakh. Then you should debit PL account, that is 2 lakh. To GG payable. Understood the journal entry? So first grant liability account debit means unutilized grant, then unamortized grant, then amortized grant, in this way order. Means first debit grant liability, then deferred grant, then the amount which has been transferred to PL account debit. Understood? This is the order. Means if suppose only 9 lakh is refundable, 9 lakh is refundable, government says one concession we are giving 1 lakh, you are not supposed to refund, only 9 lakh refund. So debit will be what? Entire 2 lakh will be debited grant liability, 6 lakh will be debited deferred income, deferred grant, and balancing figure will be 1 lakh, means PL will be debited with only 1 lakh. PL will be debited with only 1 lakh. Understood this point? Have you understood that? That is only given यहाँ पर check करो कि first GG account means unutilized grant, then deferred grant, unamortized grant, then PL account amortized to GG payable, then GG payable to cash or bank. GG payable to cash or bank. Understood? Correct? Have you understood? Have you understood? Can I ask one question? Can I ask one question? If you permit me, permission granted. The question is that this refund of government grant will be changes in accounting policy or changes in accounting estimate. 2 marks MCQs. This refund of government grant will be treated as changes in accounting policy or changes in accounting estimate. Changes in accounting policy, changes in accounting estimate. First, Accounting estimate correct. I was expecting correct answer only. A government grant that become repayable should be accounted for changes in accounting estimate as per the requirement of India said. Chapter is over. Only one special point that is related to appendix A to India's 20. You can see in AS 12 when you are in CA Inter, you have done one grant, government grant in the nature of promoter contribution. But there is no specific guidance is given under India's 20 and therefore one appendix A has been attached. So what appendix A is saying that government grant related to government grant in the nature of promoter contribution will also meet the definition of government grant, even though there is no specific specific point about operating activities. Normally, what is the definition of government grant? With condition related to operating activities. So one doubt came that it is the nature of promoter contribution, so it is related to investing activities. So one clarification has been given by the Ind AS 20 appendix A. That is, even though there is no specific inclusion about operating activities, it will be considered as government grant and it will be as per the definition of government grant only. And therefore, whatever grant you have received in the nature of promoter contribution will be also transferred to PL on systematic basis. It cannot be transferred to capital reserve. Understood? Same thing has been given. हो सकता है this type of question can be asked in multiple choice question. Disclosure requirement you can do by your own. I will not do. This is also very important point. Disclosure in the statement of cash flow. Disclosure in the nature of cash flow can be asked in exam. The purchase of asset and the receipt of related grant are disclosed as separate item in the statement of cash flow. Means you purchase asset and the grant receipt, so you can't show the net amount. Purchase of asset will be separate amount and receipt of grant will be separate amount. This present is done irrespective of the fact the grant is deducted or not deducted from related asset for the purpose of presentation in the balance sheet. Even though you have deducted grant from the cost price of asset, but then also in cash flow statement purchase of asset will be separate and grant received will be separate. Got this point? So any grant received for the purchase of asset will be investing activities, means will be related to investing activities. Chalega? Yes, sir. One reference question 8 is given. Just see what they want to say. Good question. What they want to say. And you just read 7 and 8 by your own. You will be able to understand. Okay. This is a very simple question which you can do by your own. Any doubt? Now let us come to the question. Ind AS 20. Question number 10. Come to question number 10. This is very easy question. A Limited has received a grant of 10 crore in the year 2001-2002 from the local government in the form of subsidiary for selling goods at a lower price to lower income group population in a particular area for 2 years. A Limited has accounted for the grant as income in the year 2001-2002. While accounting for the grant in the year 2001-2002, A Limited was reasonably assured that all the conditions attached to grant will be complied with. However, in the year 2005-2006, it was found that A Limited has not complied with the above condition and therefore notice of the refund of grant has been served to it. A Limited has contested but lost in the court and now grant is fully repayable. Token is it was related to income already transferred to PL. So now what journal entry you'll do for the refund? The journal entry is what? Key. The journal entry will what? It will be PL account debit, means you can say PL account debit also. So they have written repayment of government grant to GG payable, then GG payable to cash or bank. Or directly you can say PL account debit to GG payable and GG payable to cash or bank, 10 lakh, 10 lakh. Super easy. Yes or no? 17. Come to question number 17. 17 already I have done. 18 also already I have done. Come to 19. 19, the similar question was asked in last attempt. Same to same question was asked in last attempt. Correct? You do by your own. I will not do this. You do by your own. Must do. Same to same question was asked in last attempt. Correct? Means what was in my expected question that was asked in exam. Means when I say expected, it is expected. But you don't follow. You don't follow now. This is very good question. And trust me, I am expecting this question in exam. But I don't know what. I don't know when. Trust me, they are asking exam this question. Means when this question was asked now, I was actually shocked कि how they can ask this question in exam. This is a question of actually CA inter level. In CA inter level we expect this type of question, and they are not asking this good question, which is of course of 8 marks. Let me do this question. A Limited is engaged in the manufacturing of certain specialized chemical. During the manufacturing process, certain wastewater is produced which is released by A Limited in nearby river. To reduce pollution of the river, the state government has introduced a scheme with the following salient features. If a manufacturer installs certain pre-approved wastewater treatment, then government will provide interest-free loan equal to 50% of the cost. Interest-free loan, concessional loan, yes sir. But 50% of the cost. Such loan is repayable to the government in 5 years, and that is repayable in 5 years. The manufacturer availing the benefit of the scheme must treat the wastewater of his factory using the specified plant before releasing it to the river. Okay, this is the condition. If this condition is violated, the entire loan become immediately repayable to the government along with the penalty of 10 lakh. This entire loan plus penalty of 10 lakh will be repayable. Cost of the wastewater treatment plant to be installed to avail the benefit of the scheme is 50 lakh. So cost of the PP is what, 50 lakh, means we receive a grant of 25 lakh. A Limited decided to utilize this scheme because if the water to obtain the similar loan, if it were to obtain the similar loan from a bank, it would be available at a market interest of 12%. So 12% market rate of interest is given. Accordingly, A Limited applied for and obtained the loan of 25 lakh on 1st April 2001. A Limited purchased and installed the plant such that it became ready for use on the same date, and they purchased the plant and it was ready for use on the same date. A Limited has an accounting policy of recognizing the government in relation to depreciable asset in the proportion of depreciable expense, means it will be treated as deferred income. It has determined that plant will be depreciated over 5 years using straight line method. Okay, understood point? Correct. In the month of March 2003, in the month of March 2003 means, can I say it is second year only? Because 2002 is the first year, 31st March 2002 is the first year, 31st March 2003 is the second year. Government official conducted a surprise audit and it was found that A Limited was not using the wastewater, means some condition was violated. Accordingly, on 31st March 2003, the government ordered A Limited repay the entire amount with the penalty. A Limited repaid the entire amount on 31st March only. Means you need to now measure the, means give accounting treatment. Super question. Or super question or not. For CA final level, this is a good question or not. But this question they are not asking. They are asking lollipop question. Just try to understand. Instead, know what you are studying, what you are not studying. Got this point? Now, in this case, first we need to find out fair value loan. Can you say fair value loan 25 lakh is the loan amount? Is repayable after 5 years. Rate of interest 12%. Can you see you can find out present value? The present value factor you can calculate, and that will be 0.567. So this is the present value, means fair value loan. So 25 lakh minus 14 lakh 17,500 means the difference amount will be treated as deferred income. So this become your deferred income, this become your loan, and this is the total amount received. First generate is bank account debit to deferred grant income to loan payable account. Understood? Now can you see in this loan account we'll calculate interest. Interest you can calculate. Okay, let me have the answer for this, because the answer is not given in proper way. So I have the answer for this. Let me see, let me do from my answers point of view. Okay. One minute. I have my class notes. It was done in day 16. Come to day 16 and you can see this is my class note. Such a beautiful handwriting I have. Yeah. Good handwriting now. Yeah, this was the question. You can see 20 lakh. The fair value loan is 14 lakh 17,500. This is the government grant. This much you have understood. Now can you see first find out the calculation of deferred grant as on 31st March 2003 as per Ind AS 20. So this deferred income will be transferred to PL. on SLM basis over 5 year. So it was 10,82,500. So 10,82,500 divided by 5. So 2,16,500 will be transferred to PL, and this will be the closing balance of first year. Means this is unamortized portion. Then second year again 2,16,500 will be transferred, and this become unamortized portion. So you need to find out unamortized portion and how much has been transferred to PL. Understood? Then we need to also find out the carrying amount of loan as per Ind AS 109. As per Ind AS 109, so can this become opening liability? Will calculate interest expense at the rate of 12%. Contractual cash outflow will be zero because the entire amount was repaid at the end of fifth year, and this will be the closing balance at the end of first year. Then again interest will be calculated, and this become closing balance at the end of second year. So because refund was done at the end of second year, therefore we want this amount and we want this amount. Have you understood this working note? Have you understood this working note? Working note you understood. Now come to journal entry. First journal entry is bank account debit to loan payable to deferred government grant. This journal entry you can do. Then can I say we need to do two journal entry. One is for interest expense, one is for transfer of deferred grant to PL account. So you can see, of course on 1/4/2001 you have also purchased the PP account debit to bank 50 lakh 50 lakh. That journal entry of course you need to do. Then on 31st March depreciation to accumulate depreciation, that is on for 5 years. So 50 lakh divided by 5, 10 lakh 10 lakh. Then on 31st March interest expense account debit to loan payable, this is as per working note. Then deferred grant to grant income PL, this is as per working note. Understood this? Then second year all these three journal will be repeated. Once again depreciation account debit to accumulate depreciation, interest expense account debit to loan payable, and deferred grant to grant income. Just try to understand the refund has been done at the end of the year. You need to amortize grant first. First do amortization entry, then you do refund journal entry. So now we'll do refund journal entry. So what is the refund? So can you say now you need to close this account, loan payable account. You need to also close deferred income account. So what journal entry will do? Loan payable account debit as per his carrying amount, deferred grant account debit as per his carrying amount, and GG payable will be the entire amount 25 lakh, and the difference will be debited to PL. Difference will be debited to PL. This is nothing but amortized portion. Understood? And there is one 10 lakh penalty. We will do one more journal entry, penalty account debit to GG payable, and penalty will be also transferred to PL account. Correct. Then GG payable account debit to bank 35 lakh. GG payable account debit to bank what? 35 lakh. Understood? Have you understood this? So I have done in a proper working note. Institute has given in what? Cause a confusion. Therefore, I have done with my class note. Have you understood this part? Good question, but I don't know. Last attempt they have already asked a question of India's 20. So we don't know whether in this attempt they will again ask or not. Chalo, 21 also done. One more question. We have come to question number 24. It's a very good question. A case study based question. M Limited has constructed another factory few years ago with the assistance of yet another government grant. Innovative product. The grant is non-repayable, and following the construction of factory cannot be clawed back by the government. Means it is non-refundable. There are no further conditions attached to the grant, and the company is required to satisfy. Means there is no condition. The grant received has been treated as deferred income and is being credited to income statement over the same period as the factory is being depreciated. Okay. Following an adverse change in the demand of the product the factory manufactured during the year at reporting date, the directors have concluded that factory carrying value is no longer recoverable in full, and that a write down of or impairment is required. Means there is one impairment loss. The write down impairment loss then covered by the amortized deferred income balance. Sorry, the write down is more than, means the impairment loss is more than covered by the amortized deferred income balance related to the grant. Means uh, The impairment loss was more than the carrying amount of unamortized deferred income. Unamortized deferred income. Discuss in the context of India's framework and India's 20, the impairment of factory for which innovative product government grant has been received. Would your answer be different if there are future conditions attached to the grant beyond the construction of factory? Means what they are saying, whether the impairment loss can be adjusted with the deferred income. This is simple word. They are asking about this. What do you think? Bolo. What do you think? In simple word, what I am saying, if there is no condition attached, so of course impairment loss can be adjusted with what deferred income. The same answer has been given. To match the same result for the grant, which has been shown as deferred income, and the factory's initially recorded cost, it is reasonably to release an amount of deferred income to PL account to compensate for the impairment write down. Means can I say impairment loss to the extent of government deferred government grant? Correct. Now that much amount will be that much amount of deferred government grant will be transferred to PL. Will be transferred to PL. Understood. However, if there are further conditions attached to the grant beyond construction of factory, it may not be appropriate to release the amount of deferred income to compensate for the impairment write down. Entity would need to access those further conditions to determine the amount, if any, of the deferred income to release. Means in this case, if there are some conditions to be left, then we should not transfer deferred income to PL account to set off the impairment loss. In that case, we need to just check the condition will be satisfied or will not be satisfied. Got this point? Yes, sir. So good question. Can be asked in exam. This type of question as a MCQ type of question can be also asked. With this, India's 20 is completed. India's 20 is completed. Any doubt? Now, what are the questions to be done by you? Read them fast. Question 7, 8. Do 7, 8. Question 14. Question 15. Question number 16. Question number 19 already I have given. Question 22. Question 23. Done. Okay. Now come to India's 10 without wasting time. Can we come to India's 10? If you permit, the permission always granted. Okay, sir. India's 10. Chalo. Can we start? Of course, India's 10 event occurring after reporting date is very simple. I know everyone you know about this, but then also a quick revision. In even after reporting date, what are the event after reporting date? What are the event after reporting date? Your AC is on. Are you getting sound of that? The few question of India's 20 seems to be technical. They can be understood in one go, but questions are technical. Which question you are saying? How you have understood my AC zone? वाह रे वाह, you are तो परमात्मा. I was thinking you are Atma, but you are Paramatma. Very good. Which question of India's 20 you seems to be technical? Whatever technical question I have already informed you. The balance question you can do by your own. Chalo. So what is the event occurring after reporting date? Are those events which are favorable, which can be favorable, or it can be unfavorable, and which occur between reporting date and the date when which financial statement are approved. Now the financial statement is approved by director or shareholders. Correct. Just try to understand whenever there is a financial statement which has been audited, first board of directors meeting will be held and then AGM will be held. In the board of directors meeting, directors will approve it, and in the AGM, shareholders will approve it. So from this chapter point of view, whose approval is required? Board of directors approval or shareholders approval? Correct. Batao. So in this case, when financial statement are approved, to whose approval is required? Directors or shareholders? Everyone. Everyone is saying board of director, very good. अरे नालायक, shareholders approval is not at all required. Shareholders approval is only formality. So only directors approval. Shareholders approval is not at all relevant. Not at all relevant. It means, can I say, if this is the reporting date, this is the date of approval when financial statement is approved by board of directors. So these are the events which are actually covered in this chapter. Means any event which occur after balance sheet date but before approval of financial statement by board of directors. Understood? Means any event which occur once the financial statement is approved, that is not covered in this chapter. That is not covered in this chapter. Even though condition related to that is available on reporting date, even though it was related to previous year, Understood? Have you understood this point? Correct. Now try to understand this one very good question. Try to understand. Suppose this is the 31st March and this is the date of approval. But what happened? What happened? Some fraud was deducted and books of account books of account were reopened, and again financial statement was drafted, and again the meeting was held, and this is the date of approval. Correct. Now the question is that date of approval for this particular financial year will be point A or point B? Point A and point B. Point A and point B. Batao. Have you understood the question? What I said? The already financial statement was approved at the point A, but a fraud was deducted and books of account were reopened. Again, financial statement was approved by the directors, and then in point B that become the second date of approval. So point B, this for this chapter, point B is relevant. So all these events from this date to this date will be considered in this chapter. A very good question we have for this that you can do now by your own if you have understood the concept. Understood? Yes, sir. Correct. So these are some clarification given. Just read it. Can be important for multiple choice question that you can understand by your own. Can be important for multiple choice question. Now types of event. There are two types of event. One is adjusting event. One is non-adjusting event. Adjusting event are those events which relate to the condition available on balance sheet date, which provide evidence of the condition existing on the balance sheet date, What is non-adjusting event? Which relate to the condition arising after balance sheet date, which relate to the condition arising after balance sheet date, which do not relate to the condition existing on the balance sheet date. For adjusting event, we need to pass one adjustment entry and we need to do some adjustment in the relevant financial year financial statement. Correct now, so it will be adjusted to the financial statement of the reporting period, but for this no adjustment required. However, disclosure will be required if the amount is material. However, disclosure will be required in the notes to account if the amount is material. If the amount is material. Now what I will do, I will take some example first. You will say whether adjusting non-adjusting. Can we do fast? Correct. However, this chapter you can do by your own. My help is not required much, but only for basic understanding. Can we take some example if you permit me, or if you say I can proceed? Because in this chapter you need to read the question, you need to understand by your own. My help is required, means my help is not required much. So if you want, I can take some basic example for your basic understanding. Bolo. Everyone, reply fast. Yes sir means what? I will take or I will not take. Yes sir means what? It will be positive. It can be positive or negative also na. Yes sir, take. Yes sir, don't take. How can I understand? Chalo, I will take basic example. I will take not much example, only few example. Okay. Example number one. Suppose this is the balance sheet. This is the date of approval. Correct. There was the debtor, Mr. Ram 10 lakh, and a fire occurred in the factory of Mr. Ram after balance sheet date. A fire occurred after balance sheet date, and the debtor become insolvent, and now no amount is recoverable. Don't see the answer. Only listen whatever I am saying. Correct. This is the question. You say this is adjusting or non-adjusting. Fast. देखो, when I ask question of whether I should take or I should not take, there are some who will say, sir, no sir, we are best sir, we'll take sir, we'll do sir by our own. Are nalayak. Now read when I am saying, now stop saying. Okay, I know you are the best, you can do everything, but now answer. Adjusting, non-adjusting. देखो, first question, basic example, I am getting wrong answer. Now, what is basic? First question, super important. This question I take in CA Inter also, and I am getting mixed answer. Someone is saying adjusting, someone is saying non-adjusting. Means every chapter is important. This question of 4 marks can be important for your life. It is non-adjusting because fire occurred after balance sheet date. There was no condition on reporting date. It does not relate to the condition existing on balance sheet date. It relates to the condition after balance sheet date, and therefore non-adjusting. Therefore, it is non-adjusting. I'll come to all points. Example number 2. Now this is the balance sheet date. This is the date of approval. Date of approval. There was a debtor of 10 lakh. Correct. But he was a doubtful debtor. He was a doubtful debtor, and already on balance sheet date we have created one allowance for doubtful debt of rupees 2 lakh. Means on balance sheet date, means in the draft financial statement already an allowance has been created for doubtful debt as per the requirement of Ind AS 109. Now what happened? Before approval of financial statement, the debtor become insolvent and now no amount is recoverable. But now adjusting, non-adjusting, now it become adjusting because there was a condition of doubt. There was a condition of doubtful debtor, the amount will not be recovered, and this provide evidence of the condition existing on the balance sheet date, and therefore we should increase the amount of allowance from 2 lakh to 10 lakh. We should increase the amount of allowance from 2 lakh to 10 lakh. Understood? Chalega? Have you understood this point? Correct. Have you understood? Now listen carefully. Listen carefully, everyone. On 31st March, there was a debtor 10 lakh, and he was a doubtful debtor. He was a doubtful debtor. He was a doubtful debtor, and based on Ind AS 109 already on draft balance sheet, we have created an allowance for doubtful debt amounting to rupees 2 lakh, and the net debtor is coming 8 lakh in the draft financial statement. Now before approval of financial statement, what happened? We received the amount from the debtor. Means we received the entire amount from debtor. Quite possible on 31st March we were expecting the amount will not be received, but he was a good debtor only. Our expectation was wrong, and before approval of financial statement, we received the entire amount. But the adjusting, non-adjusting, adjusting, non-adjusting. If you can say answer for this, means मजा आ रहा है. Adjusting, non-adjusting. Try to react with your answer. Don't see whatever is written in my PDF. Okay? Yes, sir. Adjusting, non-adjusting, everyone. Everyone saying adjusting, very good. It means there was a condition existing on the balance sheet date, and if you receive the entire amount, now there is no need of any allowance. So we need to reverse the allowance whatever you have already created. Good point. Chalega? Yes, sir. Correct. Now on 31st March, a debtor was 10 lakh. Debtor was 10 lakh. Okay. Okay. And case number one, I have given three case. Date of approval, before date of approval means before approval of financial statement. Case number one, check collected after 31st March. Of course, it is a non-adjusting event. It is not an adjusting event. Case number one is very simple. Coming to case number two, what happened? Check dated 31st March or before 31st March, means check whose date is either 31st March or 29th March or 28th March, whatever, has been received after reporting date but before approval of financial statement. Means you receive a check dated 31st March but after, means in the next financial year, adjusting, non-adjusting. Can you pass the journal entry of receipt in this year, or it is a transaction of current year? Current year means this year. Okay, batao. Adjusting, non-adjusting, everyone. Case number two. This is CA inter level question. Adjusting, non-adjusting. Excellent. Non-adjusting, super. Super means clear, because of course you have received check after 31st March, so it means it is under your control after 31st March, and therefore it can be recognized only after 31st March. It cannot be recognized before 31st March. Now coming to example number 5, this is super. Super. Inventory cost price is 100 and RB is 120, and RB is 120 and the value is 100, means as per India's to the cost price and RB which is lower. But what happened? Before approval of financial statement, a fire occurred, inventory damage, and now NRB become 80. But the adjusting, non-adjusting fast. Adjusting, non-adjusting fast. So of course, can I say it is a non-adjusting event because fire occurred after balance sheet date. Therefore, there was no condition existing on the balance sheet date, and therefore no adjustment required. No adjustment required. But let me come to example number 6. 31st March, inventory cost price was 100 and RB was 120. And RB was 120, correct? And it was sold at rupees 80. It was sold at rupees 80, correct? Now, the same inventory in the same condition, means now there is no fire, nothing. There is no fire, nothing. Same inventory in the same condition. Are you getting what I am saying? Means same inventory. This is not a damaged inventory. Has been sold at rupees 80. Has been sold at rupees 80. So my question to you are, this is adjusting, non-adjusting. Is it adjusting or non-adjusting? If you can give this answer correctly, means you are understanding this chapter. Adjusting, non-adjusting, everyone. Example number 6. Sir, it is written adjusting, sir. Sir, array, give your answer. Give your answer. It can be wrong also. Everyone saying adjusting. Why? Because it is mentioned, or you are saying by applying your common sense. Namaskar, namaste. Matlab jabardast. Everyone is saying adjusting now because the answer is given. Now I will delete the answer. I will delete the answer. 100% correct, because NRB already I have said it is an estimation, and in days 2, if you remember, I have said first preference will be given to the agreement done on 31st March. Second preference will be given for estimation NRB for the any sale before approval of financial statement. So if any sale has been done before approval of financial statement, this is an indicator of NRB. This is one of the indicator for NRB. Understood? Yes, sir. Chalega. Yes, sir. Now, similar question. Investment in equity shares of Reliance Industry means this is one investment you purchased. The cost price was 100, market price was 950. Market price was 950. Means as per Ind AS 109, if it is measured FBTPL or FBTOCI, then we'll measure at what market price. So fair value will be equal to 950 and it will measure at 950 only. And the difference will be charged to profit and loss account. Now, before approval of financial statement, market price become 900. Market price become 900. Now you say it is adjusting, non-adjusting. Adjusting, non-adjusting, everyone. Sir, answer is given. Sir, answer is given. Non-adjusting because this is subsequent changes in the market price which is not and which is not available on 31st March. This is not related to the condition existing on balance sheet date and therefore non-adjusting event. Okay, sir. Okay, balance. I think you can do only one question I am supposed to take, which is very important from examination point of view. But this I will take when I will take Ind AS 37 because Ind AS it is linked with one of the concept of Ind AS 37. I will take this point because very important from examination point of view. But this I will take after Ind AS 37 today only. Okay. Now, so these are all examples of adjusting event given, all examples of non-adjusting event given. You can read by your own. Now there are three special case. How many special case? Long-term borrowing. Three special case. First is long-term borrowing. Now what Ind AS 10 says is suppose if you have taken any loan before 31st March, means suppose this is a bank loan for 5 years and it is a long-term borrowing. It is a long-term borrowing. But as per the terms and conditions, if any terms and conditions violated, the loan will become repayable on demand. And once the loan is repayable on demand, as per definition given under Ind AS 1 current liability, it will become current liability. Means initially it was non-current liability. Now suppose one breach of contract happened on or before 31st March. Again, this become repayable on demand. It become repayable on demand, and because of that reason it is classified as current liability. So as on 31st March it is a current liability. Now what happened? Before approval of financial statement, bank agreed not to demand as a consequences of breach. Now bank agreed will not demand. So just try to understand on 31st March it will be classified as current or non-current. Means it is an adjusting event or non-adjusting event. Batao. Everyone answer before only. Very good. It is a what adjusting event and it will be classified as non-current liability as per the requirement of Ind AS 1, but there is a carve out for this which is not relevant from examination point of view. As per IS 10, as per International Accounting Standard 10, it will be a non-adjusting event. So we are going to answer as per Ind AS 10 and therefore it will be adjusting event and it will be classified as non-current liability. Understood? Chalega? Can we move? Yes, sir. Very important, can be asked in exam. Can be asked in exam. Next point. Going concern. Going concern means what? If due to any event occurring after balance sheet date, the entity's going concern is affected. Entity's going concern is affected means suppose this is 31st March and before approval of financial statement, a fire occurred. Now there can be two situations. Going concern affected, going concern not affected. If going concern not affected, means entity is not, means after this fire entity is a going concern only, then it will be a non-adjusting event and no adjustment required. But if the going concern is affected due to this fire, then it become an adjusting event and in the entire financial statement will be redrafted by changing the basic principle of accounting, by changing the basic fundamental principle of accounting. This now the financial statement will be prepared on non-going concern basis. As per non-going concern basis, only this much Ind AS 10 has said. Ind AS 10 has not given the preparation basis for financial statement in case of non-going concern. Understood? So Ind AS 10 says what? In this case, if the going concern assumption is not appropriate, that is become invalid after reporting date, Ind AS 10 require fundamental changes in the basis of accounting. Fundamental changes in the basis of accounting for the preparation of financial statement. Means we need to prepare our financial statement based on non-going concern basis. Last point about proposed dividend. Proposed dividend. This you all know that any proposed dividend after balance sheet date but before approval of financial statement will be always non-adjusting event, and it cannot be recognized as a liability. It cannot be recognized as a liability in the financial statement. In the financial statement. Okay. So if an entity declare dividend to holder of equity instrument after reporting date, the entity shall not recognize it as a liability at the end of reporting date. But it is only for equity instrument, not for financial liability. Now, just try to understand one important point. Can you say when I say equity instrument, there are equity shares and preference shares. Write down financial instrument better. When I say financial instrument, it can be equity share, it can be preference shares. Equity shares is always equity instrument. Means normally equity shares are equity instrument. But preference shares can be classified as equity instrument or it can be financial liability depending upon situation. A best example, if I say redeemable preference share capital is a financial liability, irredeemable preference share capital is what? Equity instrument. Means for this Ind AS 10 means we are discussing right now whatever sentence, whatever para we have done, that is for equity instrument. Means any dividend declared on equity shares or preference shares which has been classified as equity instrument, correct, will not be recognized as a liability, correct, if the dividend declared after balance sheet date. Understood? It means this point is not applicable to preference share classified as financial liability. Means the preference share classified as financial liability dividend expense will recognized by applying effective interest method that will do under Ind AS 109. So in this case, dividend will be recognized on accrual basis. Understood this point? So be careful. Right now this point we are doing only for equity instrument, not we are not doing for preference share capital classified as financial liability. Understood this point? Can we proceed? Yes, sir. Disclosure requirement you can do. Now there is one special point under Ind AS 10. I don't know whether it is important, not important, but I have seen one of the question has been given in case study given by the institute from this particular para. That is Appendix A to Ind AS 10. That is distribution of non-cash asset to the owner. Distribution of non-cash asset to the owner. Means what will be the accounting treatment if the dividend is distributed in non-cash? Means dividend is not paid in cash, dividend is paid in non-cash. Understood? Correct? Means inventory distributed to shareholders. Inventory distributed to the shareholders. In that case, what will do? So what I will do, I'll take one example. From that example I will explain everything. However, this particular Appendix A to Ind AS 10 is only applicable in the books of entity who distribute dividend. It is not applicable in the books of shareholders receiving dividend. Got this point? So it is not applicable for accounting in the books of shareholders who receive such distribution. Correct? Understood? Now how to recognize? Let me take one example. From example I will explain. Entity proposed distribution of 1 pen to all shareholders on 15 Jan 2017. Entity declared and approved the dividend for distribution of 1 pen to all shareholders on 15 Feb. Means can you say on proposed date no journal entry? But when declared we will to pass one journal entry. It was actually distributed on AGM which was held on 15 May. And it was actually distributed on 15 May. Fair value of each pen on the date of proposal 500 not relevant. On the date of declaration, 500. On 31st March, 520. On the date of distribution, 515. Cost price of each pen is 400. Cost price of each pen means what? It was purchased at a cost price of 400. Number of shareholders 1000. Number of shareholders 1000. Correct. What will be the possible journal entry for this? What is the possible journal entry for this? Correct. So first, on 15 Feb means on the date when it was declared. So can you say we need to recognize the liability? Because already declared, will pass one journal entry, retain earning account debit to dividend payable. So retain earning account debit to dividend payable, but what amount? So what appendix A to Ind AS 10 says that dividend payable will recognize with the fair value of non-cash asset, not cost price, not carrying amount. Fair value of non-cash asset proposed to be distributed. So fair value is what? 500. How many shareholders? 1000. One pen to each shareholder. So 1000 into 500, it will be 5 lakh. This you understood? Now on 31st March, this date will be, sorry, 31st March. Okay. On 31st March, the fair value of the pen will either increase or decrease. Either increase or decrease. So you can see the fair value of pen from 500 it becomes 520. So what India means appendix A to India's 10 says that we need to reassess the liability. So of course the liability will increase. The liability will increase by 20 rupees per pen. So 1020 will pass one more journal entry, retain account debit to dividend payable. If suppose decrease, then dividend payable to retained earning. Understood? So retain earning to dividend payable with 20,000. With 20,000. Now on the date of distribution, once again it become 515. On the date of distribution, once again it become 515. So what our in appendix A to India's 10 says, first you should reassess the liability at current fair value. Means when you decrease the dividend payable by rupees 5 per pen, by rupees 5 per pen. So what journal entry will do? First journal entry, dividend payable to retain earning 1000 to 5, that is 5000. Now the carrying amount of dividend payable become 5,15,000. We will now do the distribution journal entry. Dividend payable 5,15,000 to pen. Let us assume this pen is inventory. So to inventory, and inventory will de-recognize that carrying amount. Carrying amount was cost price. Cost price was 400 to 1000 to 400, 4 lakh. The difference will be transferred to PL. The difference will be known as gain or loss on distribution, which will be transferred to PL account, which will be transferred to PL, not retain earning. So this gain or loss will be transferred to PL. This gain or loss on distribution will be transferred to PL. Understood? Have you understood this point? Have you understood this point? Chalega. I think this point was new, or if you have forgotten, it was a recap of that. Now, there is one more point which is very important: applicability. It applies to the following type of non-reciprocal transaction. Non-reciprocal transaction means which is one way, means distribution of dividend is non-reciprocal. Non-reciprocal. When I say contribution from the owner, that is non-reciprocal because this is one way. Contribution only received, nothing is payable. Distribution means given but nothing is receivable. So this is one way. So we call it non-reciprocal transaction. Non-reciprocal transaction. Correct? Between entity owner, distribution of non-cash asset or distribution that gives owner an option of non-cash asset or cash alternative. Means if an option has been given, either you take inventory or you take cash, this become what? And this will be also covered in this particular appendix A. Let me just give you one question. You will be able to understand, I think so. Let me create one example. Suppose on 15th March declared correct, one pen to each shareholders, correct, and the fair value is equal to 400, or cash of rupees 300. On 15th March, on 15th March, suppose they have 1000 shareholders, 60% is expected to take pen, 40% is expected to demand cash. But actual, suppose the date of distribution is 31st March, actually 20% demanded pen and 80% demanded cash. So can I say we'll first pass journal entry with this amount on 15th March because this date of declaration. So what we'll do? 1000 into 60% into 400 and 1000 into 40% into 300. What amount is coming? Can you give me this amount, everyone? Now, when did you buy this? That is not relevant. Whenever you have purchased it, that is not relevant. Okay, already you have purchased it, or you will purchase at the time of distribution. That you right now don't think about that. That type of information is not required and will not be given in the questions. Of course, can I say if you have proposed to distribute, so already you have some pen in, already you have purchased that pen. That assumption we are taking right now. Can you give me this amount? What amount is coming? Similarly, on 31st March, actual is what 1000 into 20% into 400. Okay, this amount may be changed as per the information given the question. I have not changed it. So whatever amount fair value has been changed, that will come. 1000 into 80% into 300, and what is this amount? This is coming 3 lakh 60 na? I am writing 3 lakh 60. What is this amount? The next amount? 3 lakh 20,000. So they may ask this type of question in MCQs. See what amount will be debited return earning on 15th March? It is 3 lakh 60,000. Then can I say we'll do reassessment on 31st March. 31st March, how much will be, because it has been reduced. So how much will be credited return earning? That will be difference. Difference will be what? 40,000. Difference will be 40,000. This type of question can be asked in exam. Okay, sir. Have you understood? Yes, sir. With this, India's 10 is completed. I hope you have understood. Write down some question. No question I will take from the book because all question you can do by your own. Write down some question from my side. Only three question I will give you: 12, 24, 25. 12, 24, 25. Apart from this, whatever question you think you can do by your own. So only three questions from my side: 12, 24, 25. Because all questions you can do by your own. Understood? India's 10 is completed from my point of view. Now after break, after 5 minute break, we'll take India's 37. Chalega? Understood? Yes, sir. Hi. Hello. 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 Yes. Can we start once again, everyone? Are you all ready? In this 5 minutes, what do you do? Acha, I will not ask this question. Okay. Now, one doubt came, and of course, relevant doubt only because cash dividend. Now, confusion started with non-cash dividend. One doubt will come. Arey yaar, this Sanjay Babunath asks only one question. So, which India's next class? Arey, right now, concentrate on this India's. Always think about what is happening in your life right now. Why you are thinking about future? Try to understand. Don't think about what is going to happen. Think about what actually is right now required. One doubt came. Let me complete the doubt. So cash dividend and non-cash dividend accounting treatment remains same. Only for measurement days and appendix A to Ind AS 10. Try to understand. This is suppose date when it is proposed, no journal entry. Then when it is declared, then journal entry. When it is paid, then journal entry. So what is journal entry here? Retained earning account debit to dividend payable, and here dividend payable account debit to bank if it is cash, and if it is non-cash then non-cash. Understood? Means inventory, etc. This we are discussing. Means if it is proposed, no journal entry both in case of dividend payable in cash or dividend distributed in non-cash. When declared, then will pass one journal entry retain account debit dividend payable. Now in case of non-cash, it has been given under appendix A to India's 10 that it will measure at fair value of that non-cash asset on the date of declaration. Then on distribution, when it is actually paid, dividend payable to bank and dividend payable to non-cash. In case of non-cash, there will be some difference between fair value and carrying amount of the asset distributed, and the difference will be transferred to PL. Understood now? I think Geeta, your doubt is over. Chalo. I think the doubt is over. Now come to Ind AS 37. Once again, super easy but important. Provision, contingent liability and contingent asset. Provision, contingent liability and contingent asset. Correct? Understood? First, my question before I start, whether provisions are liability or provisions are not liability. First, my question to all of you before I start, these provisions are liability or it is not a liability? Everyone? I will ask 3 4 questions. Let me understand what you know, what you don't know. Provisions are liability or provisions is not a liability? Everyone respond fast. Very good. Answer is correct. Answer is correct. Okay. Now, my question to you are whether provision for doubtful debt is a liability. My next question, whether provision for doubtful debt is a liability. Next question, provision for doubtful debt. In Bachpan you have used this account for debtor. Whether provision for doubtful debt is a liability, it is not a liability. I don't know whether you are saying yes or no because two questions are mixed. So it is not a liability. It is not a liability. the provision for doubtful debt is not a liability. Correct now, because it is just like a, this is nothing but reduction in the value of asset. So any reduction in the value of asset, it is an adjustment to asset, that is known as impairment loss. So impairment loss is not covered in this chapter. Any impairment loss related to asset is not covered in this chapter. So provision for doubtful debt, actually the name is not correct. The name should be allowance for bad and doubtful debt. So that is given under Ind AS 109. So I will say provision for doubtful debt is not a liability. I will say the name is only not correct. The correct name should be allowance for bad and doubtful debt. So whenever I say provision, provisions are only liability. It cannot be what? Adjustment to asset. Okay, yes, sir. Now my last question: whether contingent liability is a liability? Whether contingent liability is a liability? Whether contingent liability is a liability? Everyone, fast. Whether contingent liability is a liability? No, 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 no. Contingent liability is also not a liability. Contingent liability is also not a liability. If it is liability, then it will come in the balance sheet. It is not a liability. It is not a liability. It means first we need to understand what is the meaning of liability. Then only we can understand why provision is a liability and why contingent liability is not a liability. So contingent liability is not a liability. Correct? Last question. When I say provision, provision, correct? Option number A will always happen. B may or may not happen. C will never happen. Which option is correct? A, B, C. Which option is correct? A, B, C. Provision. So provision means what? Correct. Expected expense. Provision is expected expense, we can say. So it will always happen, or may not happen, or will never happen. Option number A, B, C. If you are saying A means doubt, it is B. B is correct. B is correct. Now when I say contingent liability, so for contingent liability A, B or C? Now please answer contingent liability A, B, C. Otherwise I will be confused. You are saying about provision or contingent liability. So contingent liability is A, B or C? Say contingent liability A, contingent liability B, contingent liability C. That, otherwise I will think that you are saying about provision. I will be confused. For contingent liability, which option is correct? A, B or C? So everyone, B is only correct. B is only correct. It means both provision, both contingent liability, it is an expected expense which may or may not happen. But in case of provision, the chances of occurrence of that loss is what? Probable. In case of contingent liability, the chances of occurrence of that loss is not probable. But both may or may not happen. Understood now? So when I say provision, it does not mean it will always happen, but the chances is more. But in case of contingent liability, chances are less. This is the only difference between provision and contingent liability. Provision or contingent liability. Understood? Have you understood? The last point. My question: provision arises due to past event or future event. Provision arises due to past event or future event. Provision arises due to past event or future event. Excellent. It is past. Very good. Contingent liability arises due to past event or future event. Contingent liability arises due to past event or future event. Nalayak, not future, past, past, past. Contingent liability is also past event. Means future event is not covered in this chapter. Correct. It means, can I say, any expected expenses, any expected expenses or losses arising from past event, arising from past event, correct, arising from past event may be provision or may be contingent liability, may be provision or may be contingent liability. So now we need to understand when it will become provision, when it will become contingent liability. Am I right or not? Am I right or not? So any expected expenses or losses arising from past event, arising from past event may, we need to recognize either provision or contingent liability, either provision or contingent liability. Yes or no? Means we need to recognize. I have used wrong word recognition because contingent liability is not recognized. I will say expected expenses or losses arising from past event may become provision or it may become contingent liability. It may become provision, it may become contingent liability. Now we need to understand when it will become provision, when it will become contingent liability. Understood? Same thing. Bhavana, whatever I have said, you also said same thing only. Chalega? Means you are repeating my words? You are repeating my words? Thank you very much. Okay. You can also become teacher. Now let us come to the chapter. Once I think basic doubt is clear or not. The basic doubt, I always think there is a basic doubt about this chapter. So I first targeted that. Now let us come to this chapter. So provisions are liability for uncertain timing or amount. Either timing is not known, when to pay that amount is not known, or the amount of payment is not known, or both is not known, or both is not known. So provisions are liability of uncertain timing or uncertain amount. Understood? It means when I say provisions are liability, so we need to understand what is the meaning of liability. So liability means present obligation arising from past event. Present obligation arising from past event, the settlement of which is expected result in outflow of resource from the entity. The settlement of which is expected result outflow of resource means, of course, settlement will be done in future. Settlement will be done in future, but obligation is right now, and that obligation is present obligation. That obligation is present obligation. So what is the meaning of present obligation? Present obligation means chances of occurrence is more than 50%. The chances of occurrence is more than 50%, then we call it probable on reporting date. Probable on reporting date. The provisions are liability. If these two conditions are satisfied, it is a liability. And if it is of uncertain amount or timing, that liability become provision. That liability become provision. Understood? Means, can I say any liability with certain amount and certain timing is a liability? Means that will be pure liability. But any liability with uncertain amount or uncertain timing will be provision, and that provision require estimation, because this need to be estimated, which requires measurement by substantial degree of estimation. So can I say in simple word, any liability which require estimation is provision. Any liability which require estimation, for which either amount is not known or the payment timing is not known, so for that estimation required, so that become what? Provision. Understood? Chalega? Yes sir, correct. Now this you can read by your own. Now recognition of provision, so there are three conditions. When three conditions are satisfied, provision will be recognized in our books of account. So when I say recognize, recognize means we need to pass journal entry. Journal entry is very simple. PL account debit to provision, PL account debit to provision, or I will say expense account debit to provision. Expense will be debited to PL. So expense account debit to provision. So this journal entry will be done when three conditions are satisfied. Three conditions are satisfied. First, there must be present obligation arising from past event. There must be present obligation arising from past event. Outflow of resource which is required to settle the obligation must be probable, and outflow resource must be probable must be probable, and reliable estimation can be made for the amount or timing of the obligation. Means you can measure the amount. Of course, if you can't estimate, you can't pass the journal entry. So we are able to estimate the amount of provision. If you are not able to estimate the amount of provision, then how can we pass the journal entry? Then we can't recognize the amount of provision. So there must be present obligation. Present obligation means obligation is probable, obligation is probable, and outflow resource must be also probable. So both are probable. Means chances of obligation is also more than 50%. Chances of occurrence of that event is also more than 50%. Correct? And outflow, the chances of payment is also more than 50%. Means if you can avoid payment, then we can't recognize the provision. So it means if the entity can avoid payment even though there is a present obligation arising from past event, then provision will not be recognized. Understood? So what Ind AS 37 says that if any obligation is dependent on future conduct of business, if any obligation is dependent on future conduct of business, no provision will recognize, because in that case future expenditure can be avoided. So if any obligation which is dependent on future conduct of business, for that no provision will be recognized. It means only those obligations which are independent, from the entity's future conduct of business can be recognized as provision. Understood? Have you understood this point? Bolo. In this any doubt? Means a best example, we say that if suppose you purchase aeroplane, you purchase aeroplane, you are Ambani family, you are from Ambani family, correct? Now you purchase one aeroplane for public transportation, means you are a company for public transportation via aeroplane, and there is one National Aviation Act, suppose, and as per that act you need to do major inspection of that aeroplane after every 3 years, and the amount of that major inspection after 3 years is suppose 10 crore. So can you see, the day when you purchase the aeroplane, you have an obligation to perform major inspection after 3 years. Correct? Now the question is, should we recognize provision right now? So what Ind AS 37 says that this expenditure, this obligation is dependent on future conduct of business. It is quite possible before 3 years the aeroplane may be discarded, aeroplane may be sold. In that case, no major inspection required, and therefore no provision is required. So any obligation which is dependent on future conduct of business, for that no provision will be required. No provision is required, even though there is a present obligation arising from past event. Understood? Have you understood this point? Correct? Yes, sir. Very good. Now, this obligation, when I say obligation are of two types. Obligation can be either legal obligation or constructive obligation. Both are covered under Ind AS 37, and for both legal obligation and constructive obligation, we to recognize provision. Legal obligation means any obligation which arises due to contract or due to the requirement of any act. Either due to contract or due to the requirement of any act. This is very simple: due to contract or due to any act. However, constructive obligation arises due to entity's own action. Either due to any past practice or any published policies or any specific statement. Understood? Got this point? It means, suppose if I say right now that right now we have done one contract that I will teach you practice batch in free. This is contract. But right now, if I have done some announcement that anyone who score 90% above in FR in ICI exam, correct, I will give an award of 20,000. It is only in class, correct? Now understood? Are you getting? I'll give an award of 20,000. So can I say this become a constructive obligation? It become a constructive obligation because I have done some announcement and you have a valid expectation right now, and this create an obligation on my part, and therefore for this a constructive obligation arises, and I need to create a provision based on estimation. Now how to do estimation, that is something different point. So which indicate that entity will accept the responsibility and create a valid expectation on the part of other party. So of course for constructive obligation also this chapter will be applicable. Chalega. Now, there is very important point for legal obligation. What they want to say? Any legal obligation arises only when the legislation are enacted by on or before reporting date, or it is virtually certain that legislation will be enacted in a short period of time. Means legal obligation depends upon whether act is enacted or not yet enacted. If enacted, legal obligation provision is required. If not enacted, but it is virtually certain by the end of reporting that it will be enacted in short period of time, then also legal obligation will be there and provision is required for that. So this is very important word. Either it is enacted or it is virtual certain. Virtual certainty means what? The chances are more than 95%. Chances are more than 95%. Correct? It means suppose both the bill has been passed in both the houses, only some formality is left by the President of India to sign the bill. You know, President sign is only a formality in India. So once the bill has been passed in both the House of Parliament, can you say it is virtually certain that it will be enacted? So even though it is not yet enacted, by the end of 31st March, it will be virtually certain that it will be enacted, and of course it will be considered as legal obligation, and if all the three conditions satisfied, we need to recognize the provision. Chalega? Understood? This much, any doubt? Correct. Provision understood. Coming to contingent liability. So what do you mean by contingent liability? So what India's 37 says that contingent liabilities are present obligation. Contingent liabilities are present obligation arising from past event which cannot be recognized as provision. Why? Because either outflow is not probable or reliable estimation cannot be made. Understood this point? Means any present obligation which cannot be recognized as provision will become contingent liability. Any present obligation arising from past event which cannot be recognized provision because any one of the condition was not satisfied will become contingent liability, or it is possible obligation arising from past event. So any possible obligation arising from past event will be always contingent liability. Understood? So can I say in simple word, any present obligation arising from past event which cannot be recognized as provision will become contingent liability. Any possible obligation arising from past event will be always contingent liability. So what is possible obligation? Possible obligation means obligation is not probable on reporting date, means chances of occurrence is less than 50%. Chances of occurrence is less than 50%. Understood? So that become possible obligation. Understood this point? Have you understood this point? Bata. Chalega? Correct. So can you say we don't recognize contingent liability? We only disclose the contingent liability in our notes to account. So no recognition, only disclosure of contingent liability in our notes to account. Only disclosure of contingent liability in our notes to account. Correct. This is one para given in this. When an entity is jointly and severally liable for an obligation, then the part of obligation that is expected to be made by other party is treated as a contingent liability. Let me give you one example. Suppose A Limited and B Limited is a partner in AB and company. This is A Limited, this is B Limited. Company can be partner in a partnership firm. Company can be partner in a partnership firm. Now, suppose there is a liability of 100 lakh in this partnership firm, and suppose the profit sharing ratio is 2:1. So can I say for A Limited, there are several this means their separate liability, their own liability will be how much? So it will not make it 2:1. Suppose 60% and 40%. So this will become 60 lakh. This will become 40 lakh. So in the books of A liability in the books of A Limited, liability will be 60 lakh. In the books of B Limited, liability will be 40 lakh. But can you say in the books of A Limited, there will be a contingent liability of 40 lakh? With the part of obligation which will be made by B Limited will become contingent liability of A Limited. Similarly, in the books of B Limited, 60 lakh will become contingent liability. 60 lakh will become contingent liability. Understood? Got this point? Yes, sir. Now coming to contingent asset, just try to understand. I do detailed discussion in class, but right now only this much. Any possible asset arising from past event, any possible asset arising from past event, that will become contingent asset. Correct? So contingent asset are possible asset arising from past event. Correct. Now, in this case, what India's 37 says that the inflow, because if I am saying when I am saying obligation, it means outflow. When I am saying asset, it means inflow. So inflow will result in asset, outflow will result in liability. Got this point? So when inflow are virtually certain, when inflow are virtually certain, so whenever inflow are virtually certain, what India 37 says, then it is not a possible asset, then it is an asset and recognize it as an asset. Don't consider it as a contingent asset. Okay, sir. So whenever inflow are virtually certain, so it will not be a possible asset, it will be an asset and recognize it as what? Asset in our books of account. Means will pass one journal entry receivable account debit to income, receivable account debit to income, receivable account debit to income. Okay. But if the inflow are probable, means chances are more than 50%, but not virtually certain, means less than 95%, then it will be a contingent asset. It will not be recognized as an asset. It will be disclosed as a contingent asset in our notes to account. Got this point? But if the inflows are not probable, means chances are less than 50%, then no treatment. Then for that, no treatment. Chalega. Got this point? Yes, sir. Now coming to measurement, we can expect a question on this on measurement. So measurement very simple from examination point of view. We'll do best estimate. Now best estimate, how to do the best estimate? For that, what India's 37 says, there are two situations. When obligation involve large population. For example, suppose you have done sales to the customer and you have given warranty. So it is a large population. So of course you need to create provision for warranty based on large population. In that case, determine the expected value of obligation, that is weighted average of all possible outcome. Means whatever outcome that will be given the question, only we need to apply weighted average on that. We'll take one question on that. But when there is a single obligation, single obligation with two possible outcome, means only single contract is there with two possible outcome. If there are more than two possible outcome, once again will apply weighted average of all possible outcome. But if there are two possible outcome, yes or no, so it means in that case provision will be with the most likely outcome. Correct. So provision is created based on most likely outcome means in this case, suppose a legal case is pending and the chances of high damage and chances of low damage. High damage amount is 10 lakh, low damage amount is 2 lakh, and the chances are suppose 20% and 80%. So in this case, there are only two possible outcome, and there is a single obligation. In this case, will take most likely outcome, and the amount of provision will be 2 lakh. Understood this point? Have you understood this point? चलेगा. But whenever there is a large population, we need to apply weighted average of all possible outcome. Let me take one question for this. Come to question number 5. So that you can understand. Yeah, simple question. An entity this is a very simple question. Entity sell the goods with warranty under which the customer covered for the cost of repair. And you can see what they have given. If the minor defect, the repair cost is 1 million. If the major defect, the repair cost is 4 million. An entity's past experience and based on future expectations, 75% no defect, 20% minor defect, and 5% major defect. So based on this, we'll create weighted average of all possible outcome. So can you say the total amount is what? 1 million. 75% zero amount. So 75% zero amount. 20% they have said what? Major. 20% they have said minor, and the minor defect amount is 1 million. So we'll take 20% of 1 million, and 5% is major, and major defect amount is what? 4 million. So 5% 4 million. This is the expected value of obligation, and this amount will be the amount of provision. Correct? For this we need to also may discount it. So if the discounting rate is given, so of course we need to calculate the present value of this obligation amount. Understood this point? Have this type of question can be asked. I think in the last attempt also one question of this nature was asked in exam. Correct? Any doubt? Any doubt? How to measure, you understood? How to measure, you understood? Yes. But amount of provision shall be the present value of expenditure if the time value of money is material. If the time value of money is material means from examination point of view only simple word, if rate of discount is given, will calculate present value of provision. But if that rate of discount is not given, we will assume that time value of money is not material and will recognize provision at an undiscounted amount. At an undiscounted amount. Okay, sir. So this is only from examination point of view, because sometimes whatever rate of discount will not be given, what assumption will take that time value of money is not material. Time value of money is not material. Understood? Of course, can I say provision should be measured before tax, because provision is charged to profit before tax, and discount rate should be also pre-tax. Discount rate should be also pre-tax. One clarification has been given that while calculating provision, any gain on sale of asset will not be considered. Means suppose you are creating some provision and there is one expected gain on sale of asset. The expected gain on sale of asset will not be considered for creation or for recognition of provision. Gain on sale of asset will be covered under Ind AS 16 and will be accounted as per Ind AS 16 when the asset is actually derecognized. When the asset is actually derecognized. So gain from expected sale of asset shall not be taken into account for the measurement of provision. Understood? Correct? Yes, sir. Yeah, very good. I was saying this only. I am also tired. Super tired. But how can you say this? Sir, let's close the class for today. Arey bhai, I am here 2.5 hours. I am speaking. You are only listening. And you are saying, sir, arey bhai, chalo theek hai. Means try to understand my situation. 2.5 hour non-stop I am saying. And you are saying before me, sir, wrap up for today. This is not expected. Not expected. Okay. हाँ sir, our brain is working ना sir. चलो ठीक है. I can understand your situation also because I was also a student one day. Okay. But now only some important point means whatever points are left from India's 37 point of view, that is very very important, that we'll do in tomorrow class. I hope India's 37 you have understood till now. Whatever I have said you have understood. Tomorrow class will complete India's 37 and we'll also try to complete India's 36 also, and with that our part A will be completed. With that our part A will be completed. You can see part A is completed. Means tomorrow will complete India's 37 and India's 36. Please continue. No, no, I will not continue. If someone will say don't continue, I will not continue after that because you are not interested. If someone is said don't continue, I will stop because time is also our legal, my contractual obligation is over. You can't force me, huh? Yes, sir. So 37 tomorrow class what will do 37 and 36. Okay, sir. I hope whatever we have done you have understood and each and every point you have understood. Try to understand whenever I take this class. Do comment in the YouTube so that it will motivate me. So whenever you have listened the classes, you are happy, you are understanding. So why you are living without leaving, without without giving any comment in the YouTube? Just give it. It will be happy situation for me now. So like the video and of course do comment. Correct now, because this comment motivate me to teach in a better way. To teach in a better way. Everyone require motivation. Even I require motivation. You require motivation. But motivation is only a process to make us consistent, and self motivation is more important than others motivation. I always believe even though you don't comment, I will motivate myself to take the class in an efficient way, but motivation is required. Thank you very much for today. We'll meet tomorrow. Till then, enjoy your day and take care of. I will say always you need to be in a good condition because exam is very important. You should take care about yourself also. Eat healthy, drink healthy, live happily. Bye bye. Love you all.